Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. Last video I have completed the deductions from income, gross income from salary. That is deductions under section 16(1)(a), that is standard deduction, EA deduction under section 16(2), professional tax under section 16(3). Then I have explained the format of how to calculate the income from salary. That I have completed. This is the last theory video on income from salary. Next video onwards, I am going to start the main problems on income from salary. But before that, in this video, I am going to explain you the meaning of the term Provident Fund. What are the features of this Provident Fund? What are the different types of Provident Fund? And what is the treatment according to income tax provisions regarding Provident Fund? These things I'm going to explain. In examination, you may be asked a theory question regarding what is Provident Fund, what are the different types of Provident Fund, SPF, RPF, URPF, PPF. Individually, this may be asked in theory. Apart from that, while doing the main problems, a number of points you will get regarding contribution to SPF, contribution to RPF. So if you concentrate in this video, definitely you will not find any difficulty in solving the problem. Otherwise, you will be stuck in the problem when a point comes regarding SPF or RPF. So this video is very important. Don't leave in between. Don't skip in between. Watch the video till the end. So before explaining in detail, take a screenshot of the points which I have written, then I'll explain. Come on. Now I'm going to start the meaning of the term Provident Fund. So to promote social security among the employees, the government has framed a scheme called Provident Fund scheme. Because the employee will get the income as long as he can work. That is up to the date of retirement. After retirement, he cannot be able to work. That means he has to forego the salary. His income will be less after retirement. He will suffer financial problems after retirement. So government says we will make a plan such that after retirement the employee should not face financial problems. So as long as the employee is in service, he should save some of their income and deposit in a scheme. That scheme is called Provident Fund scheme. Suppose if the employee is working for 30 years, till 30 years, every month, every year, he is contributing something in the scheme. At the time of retirement, he will get back the refund from the scheme. With that money, he can be able to make the investment or he can do anything so that he will not face any financial problems after retirement. So to promote the social security of the employees, the government has instituted this Provident Fund scheme. The features of this scheme are: first one, employee contributes a fixed percentage towards the scheme, towards the fund, Provident Fund. Normally what will happen, there is a provision that every month 10% of salary of the employee will be contributed towards Provident Fund. Example, if an employee's salary is 50,000, so 10% of 50,000 comes to 5,000. So every month from his salary, 5,000 rupees will be deducted by the employer and deposit this amount of 5,000 in the Provident Fund scheme. It is the responsibility of the employer to deduct 5,000 from the salary of employee, deposit that 5,000 in Provident Fund scheme and pay 45,000 net salary to the employee. That means employee will contribute a fixed percentage from his salary towards the fund. First feature. Second feature, the employer may contribute the same amount or higher amount or a lower amount. At the same time, employee contributes as well as employer also contributes from his pocket. Suppose you are the employee, your salary is 50,000. So from 50,000, 5,000 rupees are deducted, and every month 5,000 rupees are deposited in your Provident Fund scheme. Apart from that, employer will also contribute from his side to the Provident Fund. In your account, 5,000 rupees will be deposited from your saving, from your income, and 5,000 rupees will be deposited by the employer also in your scheme. So double contribution, employee's contribution and employer's contribution. Third one, when the employee retires, he will be paid back his contribution, employer's contribution along with interest on both. So what is the next feature of this scheme? When the employee retires. Example, if the employee retires after 30 years. At the time of retirement, he will get back his money from the Provident Fund scheme. So he will get back his own money, and also he will get back the money which is contributed by the employer and the interest on both these amounts. The whole lump sum amount the employee will get at the time of retirement. In case of death, the amount will be paid to legal heirs. Suppose all of a sudden the employee dies, then whatever amount is lying in the Provident Fund account, that amount will be paid to the legal heirs. These are the features. Now, what is the effect of this Provident Fund? First of all, employer's contribution to PF. When employer is contributing from its pocket into PF of the employee, then your employee's side, it is an income. Example, monthly 10,000 rupees are deposited in your PF account. Out of 10,000, 5,000 you are depositing and 5,000 employer is also depositing. So whatever employer deposits in your account, that is an income to you. It becomes an income. Unexempted amount is taxable under the head salary. Some amount is exempted, some amount is unexempted. So if employer's contribution is unexempted, that will be taxable under the head salary. Then employee's contribution. When employee contributes from his salary, it is a saving. Suppose your monthly salary is 50,000, but out of 50,000, employer is deducting 5,000 and paying to you only 45,000. So what about the remaining 5,000? The employer is depositing in your account. So it is your savings. It is your savings. If it is qualified saving, the deduction is allowed under section 80C. If your savings are qualified saving, then you will get deduction under section 80C. Then interest credited in PF, it becomes an income. When every month contribution is made to Provident Fund by the employee and the employer, both contribution is being deposited, it will generate interest. So interest is an income in the hands of the employee. If it is unexempted, then it will be taxable under that salary. So when it is unexempted, we'll study further. So this is the effect of this Provident Fund. So remember, what you have to remember is, in this Provident Fund, employee contributes, employer contributes, and interest will be credited in both, on both employer's contribution and employee's contribution. Now, kinds of Provident Fund. Broadly, we have 4 types of Provident Fund. That is Statutory Provident Fund, SPF, Recognized Provident Fund, RPF, Unrecognized Provident Fund, URPF, and Public Provident Fund, PPF. So from income tax point of view, 4 types of Provident Fund are there. One by one we have to study. Remember, this is very important because whatever I am discussing now, this may appear in the problems. In the next video, I am going to start the problem. In each and every problem, you will come across about the Statutory Provident Fund or Recognized Provident Fund. At that time, you must know the provision, whether it is taxable or not taxable. First of all, Statutory Provident Fund, SPF. It applies to the employees of central government, state government, local authorities, universities, and other recognized educational institutions. This SPF will not be applied to business organizations. This SPF will be applied to central government employees, state government employees, universities, or other educational institution, even local bodies, yes, local authorities, even local authorities, municipalities, etc., they are having this SPF. SPF. Now, employer's contribution. When the employer is contributing into the SPF of the employee, it is fully tax-free. It is fully tax-free. Nothing is taxable. For example, you are an employee of state government or central government. You are a government employee. In your organization, the employer is maintaining SPF. So every month the employer is contributing in your SPF. Income Tax Act says contribution, employer's contribution to SPF, fully tax-free. This point you have to remember. Very important point. Employer's contribution to SPF, fully tax-free, exempted from tax. Second, employee's contribution to SPF fully qualifies for deduction under section 80C. Fully qualifies for deduction under section 80C. Thirdly, interest credited in SPF, completely tax-free. Whatever interest is credited in SPF account, that interest is completely tax-free. That means it's the best form of Provident Fund. But this SPF is applied only for central government employees, state government employees, local bodies employees, university employees, or other educational institution, recognized education institution employees. For them only this SPF will be applied. Again I repeat, employer's contribution to SPF, fully exempted from tax. Employee's contribution to SPF fully qualifies for deduction under section 80C. Interest credited in SPF, completely tax-free, completely exempted. That's it. These are the points you have to remember for SPF. Now, second Provident Fund is Recognized Provident Fund, RPF. When a Provident Fund is recognized by the Commissioner of Income Tax, CIT. CIT stands for Commissioner of Income Tax. So if the Provident Fund is recognized by Commissioner of Income Tax, then it is known as RPF, Recognized Provident Fund. Generally, it is meant for business establishment in public and private sector. Remember, SPF will not be applied by business establishment. It will be applied by central government employees, state government employees, universities, etc. But this RPF will be applied in business establishment in private and public sector. Now, what are the rules? Employer's contribution. When employer contributes into RPF, up to 12% of salary is exempted. Over 12% of salary, if it contributes, then excess amount will be taxable under the head salary. Suppose you are the employee of a business organization in which RPF is applied. RPF is applied. The employer contributes 15% of salary in your RPF account. 15% of salary employer contributes. So Income Tax Act says up to 12% exempted. But employer is contributing 15%. So 3% more employer is contributing. That 3% of salary is taxable in your head. That means when you compute income from salary, under that salary, you will take employer's contribution to RPF in excess of 12%. Up to 12% if the employer contributes, it's a tax-free. It is tax-free. Then employee's contribution. Employee's contribution to RPF fully qualifies for deduction under section 80C. Remember this. Then interest credited. Interest credited to RPF is exempted up to 9.5% rate. This 9.5% rate is specified by Income Tax Act. Income Tax Act says if interest is credited in your RPF, up to 9.5% it is exempted. If the interest is credited more than 9.5%, the excess is taxable under the head salary. Under that salary. So these are the provisions regarding RPF, Recognized Provident Fund. Then comes to unrecognized provident fund. A provident fund which is not recognized by the Commissioner of Income Tax is called unrecognized provident fund. And this provident fund will be operated. This URPF is operated only in private establishments. Even public business establishments will not adopt this one. Only private small business organizations, they may adopt URPF. So employer's contribution, first of all, employer's contribution, it should be ignored. Ignoring does not mean it is tax free. When the employer receives the refund on his retirement, then employer's contribution and interest thereon will be taxable. Now see, if you are working in a private establishment where URPF is applied, URPF, unrecognized provident fund is applied, employer's contribution to URPF should be ignored, should not be considered. Should not be ignored का मतलब ये नहीं है कि it is tax free. No, it is taxable. When it is taxable, when the employee retires, he will get the refund from URPF. So at the time of refund of URPF, the employer's contribution and interest credited thereon, that will be taxable. It is not taxable right now, but it is taxable at the time of retirement, at the time of refunding from the URPF. Then employee's contribution. The employee's contribution to URPF will not qualify for deduction under section 80C. See, in case of SPF and RPF, employee's contribution to SPF or employee's contribution to RPF fully qualifies for deduction under section 80C. But employee's contribution to URPF does not qualify for deduction under section 80C. Now, interest credited in URPF. Interest credited in URPF should be ignored. Ignored does not mean that it is tax-free. It is taxable. Interest on URPF is taxable at the time of retirement. When the employee retires, he will get the refund from the URPF. When he gets the refund from URPF, in that case, employer's contribution and interest credited in URPF, the whole amount is taxable at the time of retirement. These are the provisions regarding URPF. Lastly, PPF, Public Provident Fund. Public Provident Fund. This is the last type of provident. PPF is operated under the Public Provident Fund Act 1968. A law is passed. The law was passed in the Parliament called Public Provident Fund Act 1968. In that act, this PPF will be operated. SBI or its subsidiaries. Then who will maintain this PPF? Who will maintain this PPF account? The Public Provident Fund will be operated by SBI, State Bank of India, or its subsidiaries, or authorized nationalized banks. The government has authorized some nationalized commercial banks or specified branches or post offices. Nationalized banks or specified branches or even post offices are also authorized to operate, to maintain the Public Provident Fund. Right? And membership in this fund is open to all. Anybody can open the account in PPF. It is open to everybody. Whether a person from central government employee, state government employee, or local authority, or self-employed person, professionals or businessmen, etc. Any person, whether he is an employee or self-employed or professional or businessman, anybody can go and open the account on PPF by simply going to post office, by going to SBI or its subsidiaries or to nationalized banks. They can approach there and ask the person to open a PPF account. The PPF account will be opened. Now you can deposit your money in the PPF. Now, etc. can join this scheme. An employee may join this scheme in addition to the fund operated by the employer. A person already is a member of RPF or SPF or URPF. Still he can open the account in PPF. There are no restrictions. There are no restrictions. Already a person is a member of RPF, a member of SPF. Still he can open the account in PPF. No restriction are there. Anybody can open. Now employer's contribution. Employer's contribution to PPF. Normally employer will not contribute to public provident fund because it's a private one. The employer will contribute either in SPF or RPF or URPF. That is Business Establishments Provident Fund. This is not a business establishment provident fund, it is a public open provident fund. So normally employer will not contribute to PPF. However, if the employer contributes in PPF, then it will become a taxable perquisite in the hands of the employee. In the hands of the employee. You are the employee. I am the employer. I have deposited in your PPF account. In your public provident fund account, I have deposited as an employer. Income Tax Act says this employer's contribution to PPF is taxable as a perquisite in your hands. It's a rare case. Now, employee's contribution. Whatever employee contributes in PPF, that will qualify for deduction. That will qualify for deduction under section 80C. But the limit is minimum 500 rupees and maximum 1,50,000 rupees can be deposited by the employee, by any person. He can get deduction under section 80C. Now, interest. Interest credited in public provident fund is fully tax free. Remember, very important. In the coming problem you will come across. So interest credited in public provident fund is fully tax free. Note, an individual's contribution to PPF may be for himself or spouse or on behalf of a minor child. In public provident fund, whatever a person contributes, deposits, he may deposit in his own account, or he may open PPF account in the name of spouse, or he can open a PPF account in the name of a minor child. So when a person deposits in his own name PPF or spouse name PPF or minor child names, that will qualify for deduction under section 80C. That's all. So these are the provisions regarding Provident Fund. This is the end of the theoretical part of the head income from salary. Next video onwards we'll start the problems on salary income. But this video is very important, remember. Inshallah, we'll continue the problems in the next video.